Hi, my name is David Heller. I've been a financial advisor for the last 15 years, working with clients to help them figure out ways to build their wealth, but also ways to protect it. And in today's video, I'm going to go over the most widely used college savings account that's out there, or at least that I've seen, and that's the 529 plan. My intention for this video is to not only share with you what a 529 plan is and how it works, it's also to leverage my 15 years of experience when I've worked with young families who are looking to save for college education. Now, there are other college accounts that you can look into, but the 529 is really just the most widely used one out there, and it's not even close. So I'll mention those at the end of the video, and then maybe in a future one, I'll dive a little bit more deeper into those other options. So with that being said, let's get into it. A 529 plan is a tax advantage savings account that families can use to start saving for education. Historically, these accounts have always been used for higher education. So, for example, college. However, 6 or 7 years ago, you started to be able to save for grades K through 12. An example of that would be private school tuition. As long as you're a US citizen or resident alien, you can open and start contributing to a 529. So that includes parents, grandparents, relatives, and even family friends. So, one of the first questions that come up is, well, what can I contribute on an annual basis to one of these accounts? So, this is where it becomes interesting. While there's not really a specific annual contribution limit, it's going to vary by state. The max or the total amount in aggregate that you can contribute to a 529 plan for the life of the plan is anywhere between 250,000 and 550,000. It is state specific, so you're going to want to check with your state guidelines or CPA. So with all that being said, contributions can count towards your annual federal gift tax exclusion amount, which for as we sit here in November of 2024 is $18,000 per year per contributor per beneficiary. Well, then the question comes up, well, can I overfund this? Can I supercharge it? Can I pre-fund it? So the answer is yes. You can. Again, there is no annual contribution amount, but for gifting purposes, you can make an upfront contribution. It's 5 years worth of contribution amount. So 18,000 times 5 is 90,000 that you can make as an upfront contribution. Sometimes you'll see it written depending on if you're speaking to somebody or you're Googling it. It's $180,000 per couple. Now, keep in mind for gift tax purposes, once you make that upfront contributions and you have that 5 year rule, anything above that then would eat into your lifetime exclusion amount. So, the advantage of pre funding it is the fact that the money can get into the account sooner, which then ultimately means that the money will be able to compound and grow, hopefully at a steeper rate. So, some situations in terms of pre funding that I've seen in the past are where someone will get a large bonus and or maybe they receive an inheritance and they just want to be able to stick a large chunk away in an account and not have to think about it. Tax consideration. Now, in comparison to other college savings options, in my opinion, this is where 529s really start to separate themselves. It's generally because of the fact that you have large contribution capabilities compared to other plans, but then you also have the tax free growth and pull out of them. So let me explain. Contributions to a 529 are made with after tax dollars. So the money will go into the account, you then invest it, and the money will grow tax deferred, but then come out tax free if used for qualified education expenses. These expenses could be tuition, books, room and board, any sort of like technology and equipment like that. On top of that, probably one of the more attractive reasons that people will want to use some of the state run plans is the fact that you can, in some cases, be able to take a tax deduction or credit. So, to determine if you have those capabilities, you're going to want to check your state's 529 website. You can check with your financial advisor or CPA, but not every state allows you to take the deduction. The way that the deductions and credits work, it's going to vary by state. But for example, we're New York State residents. So, as a married couple, we can each take individually $5,000 as a deduction or 10,000 as a couple, but that's the max that we can take in a given year. So no matter if we have two 529s and we contribute $36,000 to those plans, 18 and 18, the max that we can take as a deduction in any given year is $10,000. Again, it's going to vary by state, so you're going to want to check that out. In contrast to that, New Jersey, they have income limits, which can either push you into the territory of where you can take a deduction or out of it. So again, you're going to just want to check with all those resources that I mentioned before just to determine if you can take the deduction, because if you can take the deduction and be more tax efficient in your overall planning, why not go ahead and do that? So, David, this sounds great. Where can I open up an account? You can open a 529 through various providers, such as maybe your local bank. You can use one of the big investment firms that are out there, either Fidelity, Vanguard, Schwab, just to name a few, not in any specific order. Or you can use your state-run plans, or sometimes they're referred to as direct plans, which are run by each state, which I'm going to get into in a minute. So before you decide which route to go, you're going to want to check things out because each offers slightly different benefits, investment options, and even fee schedules. With all that being said, in my experience, the most widely used way to open up a plan is through the state run or direct plans that I was mentioning before. Every state out there, including Washington, D.C., offers one state plan or direct plan, however they refer to it. Most state run plans, at least the ones that I've seen, give you the ability to go onto their website and open up an account. To find your state plan, it's very easy. Just go onto Google, type in your state plus 529, and then you should see your options from there. And also, more importantly, I would use those sites for sure in terms of just clarifying any information, any questions you do have. The sites, again, at least the ones that I've seen, are very self-explanatory. They're very easy to use. There's typically an FAQ that you can click on and go through. You can see the investment options. We're New York residents here, so we go through nysaves.org. That's what you're seeing here in the screenshots that I took. It's very simple to use, and all you need to do to open up an account is a social security number. To start funding an account, it's again very easy. All you need to do is link an account, whether it be checking, savings, whatever it might be, and you can do, one-time contributions, or you can set it up as an automatic draft. As mentioned before in the tax consideration sections, really the main benefit for using one of the state plans is because of the in-state tax deductions, assuming that your state gives you the ability to do that. Again, you're going to want to check with your financial advisor, CPA, or go on the website just to verify if you have the ability to have those tax deductions. Now, if your state doesn't offer those state deductions or credits, then you're basically like a free agent. So you can go out and you can use whatever state plan you want, or you can go through any provider that I've mentioned. You're not bound to use your state run plan. I'm going to touch upon this later, but if you're a New York resident and your child decides that they're not going to go to a school in New York, they can go to a school at any accredited university, no matter what state you live in. Other options besides the direct or state run plans, you can use. I've seen people on occasion use one of the robo advisors, so like a Betterment or something like that. Again, you can use one of the big investment firms that's out there. So Fidelity, Schwab, Vanguard, just to name a few. You can go through your bank if you want, or you can also go through your financial advisor. There are advisor-based plans. For example, I know that through our broker dealer with Osaic Wealth, we can open up a 529 for a client. You could still take advantage of the tax deductions if it's available in your state, but then you can have someone manage it if you'd like. Just to wrap everything up in this section, most people, like I said, I would say it's probably 95% of people that I've met with or work with will use the state-run plans. And really, I think my take is, and the reason most people use the state-run plans is because it's generally very low cost, which I'm going to get into in the next section. But you also have the ability to take those state deductions, as I was talking about before. So after you figure out where you're going to open up your account, the question then becomes, okay, well, what can I invest in? So unlike a traditional brokerage account, with a 529, you can't go out and invest in single name stocks, bonds, mutual funds, ETFs, or other investments. What you're going to find is it's similar to if you have a 401k through your employer, you'll have a pre-selected list of investment options and funds that you can choose from. So you'll have on average a choice of between 10 and 20 different funds that you can invest in, whether it be growth, value, international, balanced, fixed income. Then you have the option in terms of how you want to allocate it in terms of percentage. So maybe it's 50% in growth and 20% in international and 30% in fixed income. Whatever you decide you want to do. It's more of a DIY solution than anything else. If you don't want to do that and you want to have something that's more of a set it and forget it, you can always use target date funds. So with target date funds, they're just going to automatically adjust the asset allocation based off of the child's age. So the younger they are, the more aggressive it will be. The closer they are to going to college, the allocation will come down in risk. You will also notice too, didn't mention this, through one of the state-run plans or even through an advisor-based plans, they'll partner with one of the big investment management platforms. So, Vanguard, Fidelity, Schwab, JP Morgan Asset Management, and those investment firms will set the menu of pre-selected funds that you can invest in, and those are usually proprietary towards that particular investment firm. And if you don't like those options, you can certainly go to Morningstar and look at their annual list of top 529 plans by state. Generally, what they're doing is they're looking at each state's plan and assessing the manager and the fund options and expense ratios within those particular plans to judge how they rank. Any of the plans that are out there based off of the managers that they're using. So, maybe they might regard Vanguard funds better than Fidelity and vice versa. They'll also look at the expense ratios within those funds and, of course, how those funds are allocated and the performance of them. So if you want to get that into the weeds over what you're choosing, you certainly can go that option. To wrap everything up, before I go into some miscellaneous questions where there's some crossover in some other sections that we went over, hopefully you can see a theme here in terms of why people are generally gravitating towards using the state-run plans. It really revolves around the whole deduction capabilities, assuming that you have those, but also it's really low cost. I mean, it is a DIY option, as I mentioned before, but the fund expenses are on the more less expensive side. So anywhere, I would say, depending on the state, it's somewhere between 5 to 10 basis points, maybe as high as like 70. And there's typically a very small and minimal admin fee that they associate with it. So all in all, it's very low cost and it's just easy to use. Let's try to wrap everything up and just try to answer some of the miscellaneous questions that you could stick in some of the other sections that I went over. Can I open up an account for an unborn child? The answer is yes, you can. So that's the beauty of how these plans work, and that's what makes it very flexible. A lot of times I've met with people in the past where they don't have a child yet, or the wife is 3 months pregnant, and you can, in fact, open up a 529 plan. You really just need a social security number in order to open one up. But in those situations where maybe that kid is not here yet, you can name yourself as a beneficiary. And then when the child's born and you have the social security number, you go in and you can change the beneficiary. There are no penalties or tax consequences to do that. What if I'm a New York resident, I open a 529, and my kid decides to go to a school in another state? Can I use the funds? And the answer is yes, of course you can. As long as it's an accredited university, you can use the funds. What if they get a scholarship? What happens then? So then you have a couple of different options. You can withdraw the amount up to the scholarship amount that the child received. You're not going to pay the 10% penalty by withdrawing funds early, but you might have to pay some gains on whatever you accrued within that account. This is sometimes referred to as the qualified scholarship exception. Also, while scholarships will generally cover tuition fees and things like that, there could still be some other expenses, like we mentioned before: room and board, books, equipment, things like that. So you could use the funds for that as well. You could change the beneficiary, as I was talking about before. So maybe it's your oldest child got a scholarship but your younger one might not. You can change the beneficiary without any penalty or without any sort of tax consequences. Or if you think they might go to graduate school, you can save it for that. And then lastly speaking, and this is an interesting one that just came out, what if I have unused funds? So as of the end of 2022, the Secure Act 2.0, they introduced the ability and the option to do a Roth transfer. So this is new, and this was put into place at the end of 2022 through the Secure Act 2.0, which is meant to be used for an unused balance in a 529 that you can transfer over into a Roth. There's a couple caveats, though, to be aware of in terms of understanding how this works and if you can even do it. So there is a 15-year holding period. So the account has to be open for at least 15 years in order to be able to do one of these transfers. The contributions and the earnings within inside the account need to have been there for at least 5 years before they can be transferred. The amount that's within the 529 can only be transferred into a Roth for the beneficiary of the 529. So the beneficiaries have to be the same. There is an annual contribution limit as well, which is $7,000 currently for a Roth IRA, and then that's the max that you can transfer over in a given year. There's also a lifetime transfer limit of $35,000. So it's $35,000 per beneficiary. And lastly, there are no tax implications or penalties to making one of these transfers. Because that was also a common thing I would get from people is like, what if I don't use all of the funds? Like, what happens? And so this is just it's a nice little option that's available. So at least those funds don't go to waste. Lastly, does having a 529 or some sort of college savings account have an impact on financial aid? So the assets within a 529 are counted as parental assets, not of the beneficiary, which generally will have a lower impact on being able to receive federal financial aid. Starting in the beginning of this year, there previously had been an impact if a grandparent had a 529 and that counting for against financial aid, and that has been changed as of the beginning of 2024. Here's the last thing I'll touch upon because I don't remember if I talked about it earlier, but you can use a 529 in terms of being able to fund for private schools, so grades K through 12. That amount is $10,000 a year that can be used for private school. So keep that in mind. So that wraps up our video today. That should give you a lot of information to go through and sort of digest. As always, if you have any questions or any comments, feel free to email us through our website. We can't leave comments because of compliance reasons. Love you, compliance. But if you like this video, please hit the like button. Please subscribe for more upcoming content. I'm sure in the future I'll go through more deep dives of how to save for college, what are the amounts you want to target, some of the other college savings accounts that are out there, plus any sort of updates that come up. All right, we'll see you in the next one.